One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to Investment Banking Insights, the only podcast dedicated to helping you learn both the technical and non-technical aspects of the investment banking process. My name is Alex Mason. I am your host. Thank you for allowing me to join you for just a few minutes and share a little bit of knowledge that I've gained studying this whole investment banking thing. Specifically, the technicals right now. We're going through all the fundamentals of every subject I can get my hands on. And now we're talking about leveraged buyouts. We know what a leveraged buyout is, what it's for. We know PE firms and how they do it at a high level. Now, today, I want to talk to you about ideal leveraged buyout candidates. What are some ideal leveraged buyout candidate criterion? Because it's not always a good idea to buy certain types of companies for a leveraged buyout. There's usually certain things that make a company attractive from the investor perspective in order to make that move with a leveraged buyout deal. So here's this list of criteria that would make a good LBO candidate. And I'm going to go into further detail on these after listing all of them. And there are 5 main set of attributes here. Number 1, and this is the most important component out of all of these: stable cash flows. Stable cash flows. I mean, it kind of makes sense, right? If you're working on a deal and you find a business with stable cash flows, it's like, yes, I can make money on this, right? Because that indicates a low risk business. When your cash flows are stable, particularly if they're growing very well, that is excellent. So number 1 is stable cash flows. Number 2, you're looking for companies where there's an opportunity to cut expenses. Why? Well, if you can cut expenses, then theoretically you can increase your margins. And if you can increase your margins, that improves the profitability profile of the business. And hey, you might be able to fetch a higher multiple when you exit the deal later. So an opportunity to cut expenses is a good thing. It just means that you could help make the business more efficient. Number 3, another ideal LBO candidate attribute is that this business doesn't need lots of capital expenditure investments. Whatever capital expenditures that the business needs, maybe a lot of expenditures have been outlaid right before the deal. So let's say that there's a big piece of equipment or machinery that's brand new and you don't need to buy a new one for a while. That can be a good thing, because if you don't have a lot of capital expenditure investments, then that helps improve your free cash flow profile, essentially. Number 4 is you want a company that has a great management team that's leading the business well, that's working on making sure the culture of the business is good. That is a positive. And then number 5, you also would preferably like a business to have some kind of asset or group of assets that can be used as collateral for raising new debt. It's always easier to borrow against existing assets than to borrow against nothing at all. Like, for example, in the United States of America, getting a home mortgage is relatively simple if you have some capital and you have the credit score to back you up, because that mortgage debt is backed by the asset itself. It's backed by the house, as opposed to going out and getting an unsecured personal loan. you're going to pay a way higher interest rate on that kind of a loan because there's no asset backing it. The bank can't like foreclose on the house. And in the case of a house, they can foreclose on the house and then just sell the house and make some money back. But if you get an unsecured loan from a bank, like there's nothing to sell. So that's why an ideal LBO candidate will have some kind of asset that can be used as collateral. So that's number 5. Now, what I like to do sometimes with concepts, there's this mental model called inversion. And I love it because it helps make decision making easier and helps make learning easier. And what that is we're just going to invert each characteristic and see why the opposite attributes would be a problem for leverage buyouts. So let's go through these again, but flip everything. So, number 1, we talked about stable cash flows. What about a company that has weak or volatile cash flow? Well, this could very well be a problem for an LBO because it's difficult to predict when you can sell profitably. You may unknowingly extend your holding period. Think about companies that are tied to commodities like oil prices, for example. Those prices are going up and they're going down. Like, how do you even know when to sell, even if you were in that kind of business? So that could be a problem, weak or volatile cash flow. And then number 2, what if there's few opportunities to cut expenses? What if you have a lot of expenses that you really just can't cut? Well, this means that your margins are going to either be constant or declining, and that's ultimately going to hurt the profitability of the firm and thus its intrinsic value. Okay, number 3, doesn't need a lot of capital expenditure investment, but what if a company needs a ton of capital expenditure investment? What if it has to buy new factories, upgrade all of its equipment, upgrade its office space? Well, this presents a problem because that CapEx spending is going to tie up the cash flow that could otherwise be used for debt payments. Remember, in a leveraged buyout, there's usually a lot of debt on the balance sheet, and that debt needs to be paid by the cash flows of the business. So if you're diverting your cash flow to all these other things, you're not going to be able to leverage up as much in the deal. And then number 4, what if you don't have a great management team? What if the company has a poor management team? Well, the business management team might lack skill or integrity. That's a problem because your cash flow is at risk. You don't want people embezzling money. You don't want people who don't understand culture. You don't want people who don't know how to lead their teams well. That's a major red flag. So the value of a business can crumble very quickly if you have the wrong people leading it. And then number 5, lastly, assets that can be used as collateral. Well, if a company has little to no assets that can be used as collateral, it's just harder to raise new debt capital in order to make the purchase. It's just going to be more difficult, kind of like the example of the home mortgage versus the unsecured loan that I gave a few minutes ago. So those are the 5 characteristics that make an ideal LBO candidate. Number 1, stable cash flows. Number 2, opportunity to cut expenses. Number 3, the business doesn't need a lot of CapEx investment. Number 4, you want a great management team. And then number 5, preferably you have some assets that can be used as collateral. So those are the things that help make an ideal LBO candidate. That's what I got for you today here on Investment Banking Insights. My name is Alex Mason, and I'm so grateful for you. Thank you for listening. I'll see you on the next one, and I hope you have the most incredible day. Take care.